Although gasoline prices receive the most of the focus when discussing inflation, escalating rents for housing are another factor that has raised the numbers. Due to a shortage of available homes and persistently low salaries, our affordable housing dilemma will persist even if rent increases slow down. In today's video, we'll talk about the worst housing crash in 40 years, so stay until the end of the video to learn it all. The entire housing market is on the verge of failing. Although that may seem like a bold statement, it is supported by indisputable facts. Almost all housing indicators are giving forth ominous indications. We're discussing the issues of record low mortgage applications, soaring evictions, low consumer confidence, bankruptcies, and a housing bubble. The sand-based foundation upon which the housing market was established is ready to collapse. The property market will completely collapse within the next 12 months, shocking the entire world. The numbers are dismal. According to national real estate agency Redfin, the average asking rent for property in January increased by 15.2% over the previous year. Rents have climbed along with housing prices, and rents are under more pressure to rise as more people are priced out of home ownership. There might be a delay in rent hikes right now, although the rent growth in 2021 was staggering. According to the online rental agency Apartment List, monthly growth has only averaged 0.2% over the previous 4 months. Even if February's rise was only 0.6%, most of 2021's growth took place last spring and summer, suggesting that we might not yet be out of the woods. Rent increases are a widespread occurrence. Redfin discovered that rents increased in 48 of the country's 50 major metro areas in 2021, with Portland plus 39% and Austin plus 35% experiencing the most hikes. I suppose relocating to Texas might not be as cost-effective as some folks initially believed. The ongoing increase in home prices is associated with higher rents. The Case-Shiller House Price Index increased by 18.8% in 2021. That is the largest calendar year growth in 34 years of records and much ahead of the 2020's 10.4% gain, the experts tell us. The National Association of Home Builders claims that the U.S. home market is already in a downturn. Due to the dramatic increase in property prices over the previous 10 years, home construction has exploded, much like a bubble. The number of newly built privately owned homes is at an all-time high. Yes, a record-breaking high. More than 1.6 million homes are currently being built, which is 12.5% more than during the housing bubble of 2008. In the upcoming months, hundreds of thousands of homes will be put up for sale, but no one will buy them. Monthly home sales are currently declining sharply. Sales of brand-new single-family homes have fallen to a 5-year low of just 500 million units annually. Therefore, there is a record-high supply as well as a declining demand. Consumer confidence surveys reveal that Americans no longer hold high housing values in high regard. The Wells Fargo U.S. Housing Market Index measures single-family home buyers' pricing assurance. The Wells Fargo Index has decreased for 8 consecutive months and is now only 49 out of 100. This alarming trend indicates that housing confidence will soon reach levels reminiscent of the 2008 recession. There are other indicators, as well as the Wells Fargo Index, that reveal a troubling pattern. Numerous national surveys indicate that consumer confidence is at an all-time low. The National Housing Market Study from Fannie Mae is the finest example of the awful consumer mood. 79% of Americans believe that now is not a good time to buy a home, according to the survey. However, only 17% of the populace thinks that now is an excellent time to buy a home. Since the survey's inception in 2012, the disparity between the two percentages is the worst Fannie Mae has ever observed. Because consumer confidence is a self-fulfilling prophecy, all of this counts. Prices will inevitably decrease when everyone believes that the property market is about to collapse. Currently, mortgage applications are at an all-time low. The Mortgage Bankers Association reports that the demand for mortgages has reached its lowest point in 22 years. Rising interest rates are one of the main factors contributing to low consumer confidence. Mortgage applications are falling like flies due to mortgage rates reaching record highs. Jerome Powell, the head of the Federal Reserve, recently maintained his unwavering commitment to rising interest rates. Contrary to popular belief, Powell did not suddenly start printing money again, as evidenced by his most recent address in Jackson Hole. Powell won't stop hiking interest rates, no matter how badly the U.S. economy falters. Capitalization rates will topple the pillars of the housing market. Institutions flocked to the housing market during the last 10 years to develop investment products. According to the National Association of Realtors, institutional buyers accounted for 13% of home sales in 2021, up from only 11.8% in 2020. With the acquisition of new housing units costing billions of dollars, companies like Blackstone have increased their presence in the real estate industry. Capitalization rates, or cap rates in short form, are the main reason why institutions gravitate toward housing. Calculating cap rates involves dividing the rental revenue received by the property by its market value. The cap rate would be 4% if a home is worth $1 million and generates $40,000 in annual rental revenue. The rental sector is under tremendous strain since Powell is adamant about rising rates to 4% by 2023. The CBRE Group estimates that in the fourth quarter of 2021, the average cap rate for multifamily properties was at 4.6%. This indicates that the annual rental revenue for the typical multifamily property is 4.59%. Investors in real estate will experience a significant decline in their profit margins if interest rates rise in the future. America's housing shortage is reflected in increasing rents and home prices. After the Great Recession and the beginning of the financial meltdown in 2007, we failed to create enough housing, and this failure has finally caught up with us. More fresh development permits have been issued lately. Permits alone, however, do not constitute actual homes. Supply chain issues, increasing material costs, rising interest rates, and the uncertainty brought on by Russia's heinous invasion of Ukraine may be slowing down actual construction. The National Association of Home Builders stated earlier this month that in March, its gauge of single-family home builders' confidence plummeted to a 6-month low. And housing has a significant influence on our inflation measures. The Consumer Price Index, CPI, which measures inflation overall, is made up of a number of elements. The Shelter Index makes up around 40% of core CPI, which is CPI minus volatile industries like energy. Rent increases take time to appear in the index because of the gap between when they happen and when they do, so even if rent growth slows down, the pressure on inflation measures will remain high. According to economists at the Federal Reserve Bank of Dallas, current house price growth is most strongly associated with rent inflation 18 months later. Therefore, present inflation measures will continue to increase due to growing housing prices. But even if energy prices and supply chain constraints provide some inflation respite, high housing costs, rents and purchases significantly impact inflation. There are also fewer short-term policy choices for reducing housing costs than there are for lowering gas prices, where governments can suspend gas taxes or suggest giving cash rebates to drivers. You can't just wave a magic wand and build new homes overnight. For many people, rising housing expenses are difficult. According to conventional wisdom, a household is considered burdened if it spends more than 30% of its income on housing and utilities. According to Harvard researchers, nearly half of all renter households spent more than 30% of their monthly income on rent and utilities before the epidemic. Of course, the issue is worse than the lower household income. According to the National Low-Income Housing Coalition, millions of low-wage workers and other low-income families cannot afford a rental house due to growing prices and inadequate incomes. The adage "a week's salary should pay a month's rent" is old, but it is no longer valid for many working families. In every state in the USA, according to the coalition's analysis, a worker making the minimum wage is unable to afford a basic 2-bedroom rental home. By working a regular 40-hour work week, there are long-term solutions for both the housing supply and low incomes. But there is no magic bullet. We've allowed housing costs to rise too long while refusing to expand the supply. In terms of money, we haven't succeeded in raising the minimum wage, promoting unions, or doing other actions to enhance salaries for many working people. We are currently paying the price for those failed policy decisions, as evidenced by the inflation and housing statistics, which will likely continue to show. With that, we've come to an end. See you next time. Goodbye.